Okay, so we looked at transaction risk, and you've seen there that it is basically the risk that if you don't manage the foreign exchange rate and the foreign exchange exposure correctly, you can actually lose real money. Now, in the case of translation risk, it's something slightly different. Have a look at this definition here. Translation risk is the impact on the firm's consolidated financial statements of fluctuations in exchange rates that change the value of the foreign subsidiaries as measured in the parent's currency. This is during one financial year. So basically what you can see here is, first of all, translation risk is something that only large multinational companies or big companies with subsidiaries and exposure to many, many different currencies around the world, only these kind of companies will suffer translation risk. Now, you've all done PACC in year one, so I think you know what we mean by consolidated financial statements. Let's imagine it's a large foreign company. Maybe it's based in America. Let's say it is Google. So Google is based in America, so its home currency is the US dollar. But then Google has subsidiaries all around the world. There's Google Singapore, and it operates in Sing dollars. Google Australia operates in Australian dollars. Google UK operates in UK pounds, etc. Many, many different subsidiaries, many currencies. So each of those subsidiaries will be operating each financial year, making profits or losses, having assets and liabilities on its balance sheet. And at the end of each financial year, the balance sheets and the P&L of each of those subsidiaries around the world has to be consolidated into one consolidated financial statements in US dollars in the parent country. Okay, and of course that will be in US dollars. So you can imagine that how these various other currencies, how they perform vis-a-vis the US dollar, will have a big effect on the consolidated financials of the parent company. Okay, so that's what we're going to look at, and that's basically what translation risk is all about. In year two, I think most of you would have done financial and management accounting, and you learned about parent companies and subsidiary companies. The parent company will consolidate its financial position at the end of each financial year. That's what we call consolidation of accounts. So you bring the accounts of all the various subsidiaries in all the different currencies, and you translate them all into the currency of the parent company. In the case of Google, we mentioned before, it's US dollars. So there's not an actual movement of assets and liabilities or profits. It's not real monetary loss if the value of the balance sheet this year is less than it was last year. It's basically just a book entry or an accounting entry. So translation risk arises when the parent company has subsidiaries in different countries with different currencies, and often we call it, the accountants call it book risk or accounting risk, because the values change on paper, but it doesn't necessarily mean a real monetary loss or a real monetary gain. So take a look at this example. You're all familiar with the company ComfortDelGro. You all know Comfort Cabs, the taxi company in Singapore, but I'm not sure whether you know that Comfort is quite big in other markets, and in fact they run buses and taxis and other forms of transport in the UK. City Developments also, a Singapore firm there, and they also have a lot of assets overseas. So imagine the following scenario. So here we have ComfortDelGro. They're operating in the UK, operating their transport system, and they've obviously put investment into the UK. They've taken Sing dollars, swapped them into pound sterling, and then made multi-million-dollar investments in equipment in the UK. And that is that shows on the balance sheet of the subsidiary in the UK. ComfortDelGro UK would have a balance sheet and a P&L which is valued in pounds. And at the end of each financial year, that pound sterling balance sheet and P&L will then be translated and included in the full consolidated accounts of the parent company in Singapore, which of course is done in Singapore dollars. All right, so you can imagine, just let me click the button here. You can imagine that before Brexit started happening and people were not talking about Brexit, then the exchange rate was around about one pound is $2 Sing, or 1 million pounds is about $2 million. So that would be roughly the way that the balance sheet and the P&L would translate. 1:2. Okay. Now, if you fast forward to today and the exchange rate has fallen to £1 is about 1.7 million Sing dollars. So you can see that the British pound has lost quite a lot of value against the Sing dollar. So that means that the value of the assets and liabilities that this company has, and the value of the amount of the profit that it makes, which is determined denominated in pounds, when you translate that into Sing dollars, it's going to be less. So you have this effect of balance sheet shrinkage. So financial statements affected because UK subsidiaries accounts are in pounds, but parent companies consolidated accounts are in Sing dollars. This is translation risk, and as we say, it can cause balance sheet shrinkage. And why is that a problem? We'll talk about that in the next slide. Okay. Here's another simple example. General Motors is one of the world's largest car manufacturers. It's an American company. So General Motors' home currency is the US dollar. So let's imagine General Motors decided they want to make an investment in the UK, in Britain, and they know that that investment, the amount they need is 10 million pounds sterling. So they go along to the bank and say, I need to send 10 million pounds across to the UK. How much will that cost me? And the bank will say the current exchange rate is 1.5 US to 1 pound. So in order to get your 10 million pounds, that's going to cost you $15 million. All right, so they go ahead and do the transaction, do the foreign exchange, swap the $15 million for 10 million pounds, send the pounds across to the UK, and they probably open a bank account in a bank in London, and it has just one asset, and that is a deposit of 10 million pounds. All right, now imagine a year goes by and General Motors was busy doing other things. They didn't really do anything much about this investment. And 1 year later, they still have a bank account deposit in the UK, which has 10 million pounds in it. However, if they were to wonder how much is that worth now, if I was to translate it back into US dollars, the exchange rate has moved from 1.5 to 1.45. So now on paper, the 10 million pounds is only worth $14,500,000. So you've actually got a translation loss, or a paper loss, or an accounting loss of $500,000, $500,000. So this is a translation loss. It's not real money. They haven't actually lost any money, because maybe if they leave it there for another year and do nothing, the exchange rate will move back up to 1.5. Who knows where the exchange rate will move? So they could end up getting their money back again, or even making more. The point is, it's just a paper loss. The only way that that translation loss or paper loss could become a real transaction loss is if General Motors decided, okay, we sent this 10 million pounds across to the UK, but now we decided we don't really want to do this investment anymore. We don't need the 10 million pounds over in the UK. Let's bring it back home again. So they go to the bank and say, please bring the 10 million pounds back to the US for us. And the bank will say, okay, now the exchange rate is 1.45. So the 10 million pounds, where we exchange it for US dollars, you'll get back 14.5 million. So in this case, they actually lost a real $500,000, because initially they started off with $15 million, and now they've ended up with $14.5 million. All right, so a paper loss or a translation loss has become a real transaction loss. Okay, so what you need to get in your mind is the difference between transaction and translation. Transaction is real money, real loss, or maybe even real profit, whereas translation is just in the books, in the accounts. All right, paper loss, paper gain. So if a translation loss is just a book loss, it's not real money, then what's the problem? Why does it really matter? There are some reasons why it matters. First of all is that many of these large companies would have borrowed money from banks. And if you look at the loan agreement with the bank, it can be quite thick and have a lot of terms and conditions. Some of these covenants that the banks put into the loans would relate to things like the relationship between assets and liabilities, the size of the balance sheet, and all that. So if a translation loss or translation problem can affect the size of the balance sheet and the P&L, then that can be a negative thing. And sometimes the bank may require them to the company to top up the security they have with the bank, because they've gone outside the covenants which have been previously agreed. All right, that's going to happen, especially if you have, say, a US company which is heavily exposed to many other currencies, and during that particular year, all those currencies fell heavily against the US dollar. Then the value of the consolidated financials is going to fall dramatically, and real shrinkage of the balance sheet, and the P&L is going to shrink as compared to the previous year. And then the lenders, the bankers will say, well, that's no good, that looks terrible, you're going to need to top up your security. The other reason is quickly that things like share valuations, how much the shares of the company are worth, is based on the size of the balance sheet. And if you want to do an IPO or raise some money in the markets, etc., then people are going to be looking at your financial statements, and they'll look and say, how come in a previous year the balance sheet was worth this much, the P&L, the profit was so much, and now it seems to have shrunk quite dramatically. They may not be sophisticated enough to realize it's just translation problem because of other currencies and exposure to other markets. They may think that the company is actually performing worse or more badly than previously. All right, so sometimes the translation risk, the translation effect can have a negative effect on people who are lending money to the company or wanting to invest in the company. Okay, so there are many ways that companies and that accountants will use to try to manage the translation risk, the translation exposure. Here's one simple one. The multinational company can match its assets and liabilities, which are denominated in the same currency. So, for instance, in the case we were talking about, where General Motors sent across £10 million to the UK. So currently their UK subsidiary, all it has is one asset of £10 million. It doesn't have a liability. So the balance sheet is totally lopsided. Okay, so if they, for instance, were to take a 10 million sterling loan in the US and then invest that in the UK, then you'll find that they have a loan as well as a deposit. So when the currency of the loan, which is pounds, and the currency of the deposit, which is also pounds, whichever way the pound moves against the US dollar, then the balance sheet will move up and down proportionally together, because both sides of the balance sheet, the asset and the liability, are both denominated in the same currency, in this case pounds. All right. So that's what you call a balance sheet hedge. It's one method that can be used. But of course, you can see straight away that this is only going to work with very large companies dealing in large amounts of many currencies. It's not going to work with small little companies. It wouldn't be worth them taking out a loan just to try and balance their balance sheet. Okay, there are many other methods, but we don't really need to go into all these details unless you want to become a financial expert. Then you can study this stuff in the university. All right, let's move on to the next type of the next type of risk, which is economic risk. So the third one is economic risk. Definition: economic risk is the impact on the value of the firm's operations of unanticipated exchange rate changes. So here's an example. Just a little bit before your time, Singapore investment in Indonesia during the 1997 currency crisis, or the Asian financial crisis as it was called. The Indonesian rupiah depreciated by more than 50% against the Sing dollar and against many other currencies as well over a very short period of time. And then it took many, many years to recover. So the point is, from the point of view of Singaporean companies, they had investments in Indonesia. They could be financial investments, or they could have been investments in property and factories and plant. And these are all denominated in rupiah because they're physically located in Indonesia. But then when you look at the value of those, when you translate back into Sing dollar, then of course, because of the 50% currency depreciation, the value of those assets and liabilities and financial instruments, etc., much less in terms of Sing dollar. All right. And of course, now the way to handle economic risk, this is where you can see the difference, because economic risk is more longer term in terms of, first of all, the time it takes for it to happen, and then secondly, the strategies that you use to overcome economic risk. All right, so if you think about the three different types of risk, transaction risk, the one we looked at first, is talking about trade finance transactions, or the average time, for an import and for payments of a foreign currency amount is maybe about 6 months. All right, so the time is quite short, and who handles it in the company's hierarchy structure would be the middle level sort of management people that are doing trade finance transactions. And then if you talk about translation risk, then again, we're talking a normal exposure time of 1 year, because it's an accounting risk and it's related to the financial year, so 1 year. And then who is looking after this would be the accounting staff, the finance staff. And again, these are kind of middle management people. Okay, so now the difference is when you talk about economic risk, then the type of people in the company that are looking after this and thinking about this will be the senior management, the board of directors, because it affects the whole company. It could be in the case you can see here of Indonesia when this happened, and then there were riots in Indonesia, and when it all died down, and the Singapore people went back to look at what had happened to their factories and their offices and their businesses, and there was looting, and there were the factories had been burned down, all kinds of losses had been suffered. And so they have to make a longer term decision about what to do. Do we stay in Indonesia? Do we move out? It may not be as dramatic as that, but it could simply be that you're a Singapore firm and you're operating in China for some years, and over time you see that the operating cost in China is going up and up. Chinese economy doing well, so the workers are demanding higher levels of pay. The price of property and various other assets is becoming more expensive. So the general cost of doing business in China is going up. So then the senior management of your company will think, okay, maybe we should scale back our operation in China. Maybe we should close down one or more of the factories and move it to Vietnam, to Cambodia, to somewhere else, which is a cheaper location. So this kind of thing, you cannot just do it overnight, and you don't want to just write off a very large investment that you may have made into China in this case. So over some years, you would have to make those adjustments. So economic risk is something that companies will have to look at a senior level and make longer term decisions. So what about some strategies? So economic risk can be reduced by doing certain things. First of all, you analyze the likely changes in the exchange rate. So once again, if you're a very small company, then you can't really do that yourself. You may have to have advisors or rely on your bank manager, your bank account officer. If you're a very large company, you will have analysts, you will have an economics department, etc., and they'll be doing analysis of the markets that you're in and the various currencies, and they will give you advice in terms of the senior management, what you should do, and then you can adjust the mix of your assets and liabilities, the cash flows in terms of all the various currencies that you are exposed to. This is what you call offset strategy. And of course, the main thing you would do here is not have all your eggs in one basket. Don't be all exposed to one currency, because if that currency falls, you've got a problem. But if you're exposed to many currencies, one goes down, the others are fine, then you are sort of spread over a number of currencies, things will be better. So managing economic risk, strategy one, diversification of operations. So what should you do there? Basically, again, don't put all your eggs in one basket in terms of where you operate. And again, so small companies may not have this luxury. They're just having one location where they operate. If it's a Singapore firm and they establish their first overseas plant or first overseas factory. But if you're a bigger company, then you try to diversify your production location as well as your markets across as many countries as possible. And this will minimize the economic problems faced in any single economy. So you produce your products in more than one location, and you don't just sell them to one market, but you sell the products to as many markets as possible. So diversification of operations is one method of managing economic risk. Another thing you should do is export-oriented production. So if you set up an overseas plant and you're manufacturing in that country, and then you only just sell your products to the people in that country, then you could have a problem if the economy in that country goes down or has a problem. All right, but if you only export, if let's say the production from that factory in that country, you only sell 5 or 10% of the production to the local market, and the other 90% you sell to all other markets all around the world, then as far as your sales, again, you're only exposed to that local market for a very small amount, and then you sell your products by exporting to all the other markets. So you sort of spread your risk, and as well as doing that, you can earn valuable foreign currency, because if you have your factory in a relatively poor country with a currency which is not very strong, like say the Vietnamese dong, but you export from Vietnam from your factory and you export to Europe and get euro, you export to Japan and you get yen, you export to US and get US dollar, then you are earning valuable foreign currency in what we call hard currencies. Remember, we've talked about hard currencies and soft currencies in a previous lecture. All right, and then the last one, of course, is diversification of financing. So not just your sales and the markets you sell to, but I mean, if you're a big company and you need to borrow a lot of money to operate your business, then don't just borrow US dollar, because if the US dollar interest rate go up, that's a problem. Or don't just borrow euro, or don't just borrow Sing dollar. Borrow a whole basket of different currencies, and you'll find that if currency A, the interest rate goes up, then currency B might go down or whatever. So in general, the more you diversify the financing, the location of production, the market, all these various things, these will help you to sort of spread the risk, and that is a better way to manage your business. There you are. So there's the chapter review. These are the areas that we've studied. So this can be quite a difficult topic for some people if you're a non-financial student. But in the environment in Singapore, because as we know, we're such a globalized country, exposed to many markets, so many jobs that you may not imagine that you could be working in, that you think it's just a marketing role or it's just a simple company. You're going to come across foreign exchange. You're going to come across financing in different currencies. You're going to come across spot market, forward market, all these various things that we've looked at in this lecture. So don't think that you're not a financial student, therefore this stuff is not relevant. It can be very relevant in many different jobs, many different industries. Apart from that, it's relevant to the exam. Okay, guys, thanks.